All right, welcome friends. It's a beautiful Friday afternoon in southern Alberta, and we hope it's that way for you wherever you are. With me today is Brian Mahachik and Caitlin, who we have in the past referred to as Zorro. She's here helping us out, helps us with community engagement and some marketing things, and has been a great asset to our team. Most importantly, she's running the computer today. So welcome here, Caitlin. Thanks for being here again. Brian, we are in our second week of a 3-week series on understanding your P&L, your profit and loss. This week's topic is how to go in depth on your operating expenses.
Right.
So we think shop owners, business owners can make more money if they truly understand their profit and loss.
Yep.
Talked about that last week. So we're going to get into operating expenses today, and then at the end, we'll do our pro tip on should I buy my building or should I lease it? Question we get asked quite a bit.
On lots of assets,
Yeah, lots of, not just buildings, good point. So we'll get into that as a tip to help you kind of evaluate which spot you think you should be in. So I think that's good. Let's get after it here today. We're going to start first with the operating expenses. So this is a section of the profit and loss. Brian, tell us what's not in that section, and then we'll talk about what is.
Yeah, so in a properly laid out P&L, profit and loss, or income statement, or PRL, what's not in it should be your cost of sales. That's up top. That's where we're actually measuring our margins, direct margins, right tied into the sale. And then what typically also is not in it is the weird stuff. Tends to be called other items or other income and expenses, but those would be things like your gains and losses on maybe a disposal of a piece of equipment, or weird one-offs that don't typically happen in
interest expense, or not interest expense, interest income.
Right. Goofy things that aren't in the standard realm of your general operating expenses. So it's in a properly laid out P&L, you're going to have your up top sales and cost of sales. Then you're going to have your operating expenses, a myriad of those, and then you got your other items down below, and then your net profit and tax provisions at the bottom.
Awesome. Okay, so that's what's not in there. Cost of goods sold's not in there. Things like that. Other stuff. What is in there in general?
So it's your fixed expenses. It's your things that your general expenses, administration, your costs that are just part of the business that are there regardless. That aren't really necessarily attached to a particular sale. For instance, like if I sell a part, that's got a cost to it and a sale. But if I didn't sell the part, I probably wouldn't go down to Napa and buy it from Napa to sell to the customer, right? So it would be those things that are there in my business that are going to be there when the business is operating. My rents, my office expenses, just general administrative
insurance,
costs, things like that.
Utilities,
insurance, property taxes, if I'm in my building.
The whole big wide range.
Exactly.
Okay, awesome. And so on your statements, the statements we publish especially for our shop owner clients, it can be in a couple of spots. This schedule, where does it live?
Yes.
Statement first.
So a lot of times it depends. I guess if some businesses have more line items than other businesses. Shop owners tend to have similar type expenses. But if you're operating in a different industry, you might have more general operating expense line items that you want to see there. So it depends. A lot of times it's the optics of the statement. You don't want to have a really dirty looking, muddied income statement. You want to, it's nice and clean.
Numbers thrown all over
the place. The optics and the look and the feel of the financial statement. There is something to be said about looking at something that looks clean, right? So if it's getting too squishy, and that's not a good word for it, but like if things are looking too condensed on the statement, we'll a lot of times move them into a schedule. But if it can fit and work, it might just sit on the face of the profit and loss statement. It kind of depends, I guess, on the situation. But we generally either see it right on the face of the statement, or tied into a schedule.
No, that makes sense. I think like reminds me of what you said last week about having the importance of comparative figures. Right. As long as what you see, I can see utilities this year or this period, whatever it is, month, quarter, and I can see it from the same time, so I can look at the two and see how they compare.
A lot of that compare for sure.
Cool. Okay, so we got where it's located, what's in there. What are some of the key areas that you look at and you think our clients should look at when they're looking at the operating expenses?
That's a good question. Well, you mentioned comparatives,
Yeah.
right? That's naturally one. We want to see how our expenses line up this period to last period. But really, a lot of times the new clients that come on board, what do we typically see? We see sales.
Yeah.
And then we just see a laundry list of expenses. So in that case, I'm tending to look at the big numbers, of course. I mean, those are the ones that draw the most attention. They're the red flags, if you will.
Yeah.
And a lot of times in that case, with just sales and a laundry list of expenses, the big one's going to be salaries for most businesses, a shop for sure.
Yeah.
Well, and the cost of the parts as well. The parts will be in there. So those will be the two big ones that we're looking at. But in that situation, it's tough to know. You really got to how do you gauge your margin on labor when your labor costs are buried in a one line item of salaries with yourself, maybe your service writer, everybody, exactly. You can't break that out. So that's a big one. And we tend to see that a lot of times. The statements of the business will come in and they just got sales and the laundry list of expenses. And unless I'm doing something else in behind the scenes to manage my margins, that doesn't tell me a whole lot about the business. So that would be one of the big things that we key in on. And one of the first things that we do when we work with shop owners is we clean up the balance sheet and the financial statements, but the P&L for sure, and get it into a much more aligned set of statements that make way more sense. We got cost of sales aligning with the revenues and identify those true operational or fixed expenses. So that would be probably the first big one.
That's a great. That's maybe a great point for bookkeepers out there that are working with shops. To really get some clarity on the chart of accounts, the trial balance that they'd be familiar with, break it out in enough so that the owner can actually take data out of there and use it in a not just a big ball of clay. Right?
Yeah, exactly. If you're a shop owner and you're sitting back and you're busy because you're working with your customers, or you're dealing with whatever issues, and then you're looking at your statements at the month end or at the year end, unless you're tracking those numbers better some other way, it's pretty hard to tell you that I'm hitting my parts margin when parts is just in one line item and my sales are, I haven't broken out the sales between the various subcategories of sales. So that would be one of the key. That'd be probably the big one in that situation for sure. Okay,
so you mentioned service writer. Why do you put it up in cost of goods sold versus down in the operating expenses? What's kind of the thought there?
Yeah, well, there's really we think of the service writer as a sales function.
Right.
That's what they're really there to do.
Right.
It's there to be the salesman to bridge between a technician and the sales and the customer, and suggest those types of services that maybe are the preventative maintenance that might maybe not need today, but it's trying to ultimately help the customer in their vehicle, regular routine maintenance. So we put them up in sales or up top a lot of times because it is a function directly of the sales.
That makes sense to me. They're part of the production cycle, the production team, right? Yep. Okay. What's the second big expense in there that you tend to look at, want to compare, want to see?
Well, if there's anything weird that is also big. I mean, we talked about parts and salaries. Outside of parts and salaries, a lot of times now, rent will be one of the next biggest expenses.
Yeah.
So again, if you're renting your building, we're going to talk about it in the pro tip, but if you are renting your building, we want to see that rent expense. Unless you're living in some really high rental market, maybe you're downtown Toronto. Downtown Toronto is going to command more of a rent than Weyburn, Saskatchewan
Makes
will.
Sense.
But
Weyburn's pumping right now. I don't know.
But for the most part, we like to see that rent at a certain percentage. If you're of sales, if you're breaching that percentage of sales, you probably as the business owner should be thinking about that. Looking, am I maybe needing to renegotiate a lease, perhaps, or if my lease is coming up, I want to work with the landlord. Just not letting that get away, because your cost of your rent is it can be a big component of sales. It can be upwards of 10% of sales in some situations. We don't like to see it getting over 10%. Okay, for sure.
All right, awesome. What's a third one? Give us. We've got service writer wages. We've got rental. Give me one more.
Yes, another one would be advertising.
Okay.
And the
big cost, right?
Yeah, it is a big cost. Certainly, it depends. And again, it depends on the business. The shop, maybe they're really going hard at advertising. Maybe and their spend on advertising is more than, say, the guy down the road who's got a lot of referral and doesn't really spend a lot. So, really, it gets back to, in that case, it's like, am I getting the bang for my buck? Am I watching that? Am I throwing money away at advertising? Really, most shops that we see tend to run at about 3 to 5% of sales as their advertising spend. Some do zero because they just got that referral business. Maybe they're sitting, been around for 20, 30, 40 years, and they just got that loyal customer base and keeps coming back and forth.
And maybe could be doing better if they did have advertising.
Exactly. They could be doing better if they did have advertising. Maybe no one's told them that they should be doing that. If they're up over 10%, you better be getting some traction with the advertising dollars you spend, or rethinking about what you're doing. So, that'll be another one that we tend to look at that can get up to be upwards of the 10% of my sales, and that's a number that is now warranting me to take a look at and look into deeper. You don't want to be wasting money. Right?
Yeah, no, that's right. Yeah. All those in the scorecarding that you do that regularly. I know for a number of the shop clients monthly. This stuff is something you look at in there. Hey?
Yeah, it's part of our monthly. It might not necessarily show up in the scorecard, but as part of the monthly work that we do. We're looking at these variances. We're looking at the comparisons of expenses into sales dollars, tracking that, and then talking to you about it if we think it's maybe getting out of line, or perhaps there's opportunities, those types of things. So certainly it's in the monthly. It's in what we do monthly with our clients.
Great. I love that proactiveness.
Yeah.
That's awesome.
Yeah, telling somebody about, already their July month, first week, second week of August. That's what we want. That's what we're doing.
Okay. Cool. Thanks, Brian.
Yep.
I'll summarize that up. We think you can make more money when you understand your operating expenses.
Absolutely. Yeah, and it just, and a lot of it gets down to the organization and the cleanliness of your financials and setting yourself up for success, really, which starts at your underlying trial balance. So
awesome. Okay.
So then we'll shift over into the pro tip.
Yeah.
So you mentioned it earlier. Should I lease or buy?
Yeah.
So
the question, like everything, is it depends. Right? I know you like that one.
I love that one, actually. If you know anything about tax, or if you've been trained by anybody in tax, the "it depends" is the answer to literally every question posed by anybody.
That's right. Yeah. No, that is the question, and there's 4 ways we tend to look at it. Right? It can be complex, not always is, but we like to look at the tax. You just said it. Mm-hmm. There's a difference in the tax implications of that.
For sure.
There's finance implications to leasing and buying. There's accounting implications. And then there's actually, just if you step up and go, there's big strategic implications for what you do with your building. So I can walk through all of those, I guess.
Yeah. So those are the 4 key areas.
Yeah.
On the tax side, explain. I mean, I'm aware of it, but for our watchers out there, what are some of the things that we're looking for on the tax side?
For sure. The primary one that you'll experience most of the time is the difference between depreciation and the lease expense that happens from a tax perspective. So when you own an asset, for tax purposes, we depreciate it year after year. Right? So you get a deduction for that amount. And it's a pretty low amount on buildings, right? Generally, it's about, in Canada, it's about 4%. Right. And so you're not getting a super big benefit out of that asset on the depreciation side.
No.
Whereas if you lease, generally that lease is a full deduction all the time.
Right.
So you actually can get a better benefit tax-wise from leasing it.
Yeah.
There's some stuff as well later on if you were to sell it and things like that would apply. But what most people would experience over the course of being in that space is that depreciation versus lease type of
Yeah, if I bought a building at $100,000
yeah.
and I get 4% a year, well, $4,000 year one versus say I'm spending $1,000 a month on my rent,
Yeah.
there's $12,000. I mean, the cash flow discrepancy there, but
Yeah.
from the tax,
which we'll talk about.
yeah, from the tax point of view, the deduction of 12
Right.
is worth a lot more than 4.
Yeah.
Okay, from the finance end.
Well, and the finance side, you mentioned it, cash flow is the biggest thing, right? You get two different things happening. One is if you buy a building, you often have to put something down against it. So you've got a cash outlay right away, but then it's financed, often is the case. Versus a lease, which you don't tend to have to put as much down, but it's just that regular drip of cash flow, probably a little bit bigger than maybe the regular mortgage payment that you'd have to make because you're paying somebody else and they've got the lending and the borrowing and that kind of stuff. So the cash flow can be a big deal on the financing end. Some of it depends on your ability to borrow money, right? If you're a brand new shop, you don't have a long credit history, all sorts of things like that. You might find it tougher to get money out of the bank than somebody who's been around for 20 years.
Right.
Or you know that past track record. So sometimes lending can determine which way you'll go. And then there's also this difference between interest rates and lease rates, right? So interest rate is what you're going to pay on a mortgage, let's say, on your building. And it's often less than, in lots of cases, what a lease rate's going to be on the same thing. So, if I own the building, you're going to lease it from me. I'm going to charge you a little bit higher than what my lending rate is because I actually want to capture that spread.
Yeah.
Right. As the guy that owns it, I'm taking the risk. That kind of stuff. Right.
Right.
So we have those two things that is really a financing decision. Which one am I going to choose?
Yeah.
Which one's better for me?
And right now we're in some pretty low interest rate territory.
Yeah.
We have been for a while, right?
Yeah.
So it's been, from the borrowing perspective, it's been a lot more not lucrative, but it's been a lot more appealing.
Sure.
There were the days we hear it from a lot of clients who went through the 80s,
Yeah,
and
that's
20% interest rates and things like that. Like, $1,000 lease a month versus a mortgage payment that's at a 20% interest.
Yeah.
Those types of things are all the things that we're talking about when we're talking the finance.
Yeah.
Okay.
You bet. Yeah. So
No,
that's good. Yeah, we can move from there.
Okay.
Yeah.
So the accounting side.
Yeah.
On the accounting side, then, what are we looking at from there?
Not a ton. You'll see some big differences. In the accounting side, primarily our focus is on the balance sheet, where if I buy something, an asset, typically it goes on my balance sheet. Shows that I have an asset here, I've got a liability here to offset it. And in certain cases with leases, it doesn't exist on there at all. So if a bank is looking at me, that way they won't see those big assets and liabilities. They'll just see this lease obligation, right? This thing that has to happen over and over again. So on the balance sheet, that's what you'll see. On the P&L, which we're talking about, and in the operating expenses actually is amortization, right? And so when I own a building, I'll see an amortization expense in there, kind of to capture the use of that asset over its useful life.
Yeah. Right.
If I'm leasing, Brian, I'm going to see a lease expense instead. Right. So that $12,000 you spoke about, it's just going to show up a lease expense, 12, 12, 12, 12 over and over again.
Yeah.
So those will be the primary differences on the accounting side.
I always have a bit of not a tough time explaining it, but when clients go, well, why am I amortizing my building when my building generally goes up in value? That's right. But it's just the accounting principle and behind the scenes is what we're talking about here.
Yeah, and in reality, buildings the value of them almost plays no factor at all in accounting.
Yeah.
Right? We try to capture that use of that thing over its useful life.
Right. Exactly. That's the accounting principle.
Yeah. Yeah. Super tricky.
Okay. What else? So what's the last one? From a strategic end? If I'm looking at leasing versus buying, right? What would I be looking for there?
So pop out of the regular operations of your business and go up here and say, okay, what's best for me as a business owner over the next 10, 20 years that might make this decision for me, right? So if you're a brand new shop, you might start with one bay, right? You've got one technician working for you. You're in the shop half the time working.
Yeah.
And you're thinking, okay, in the next 10 years, what do I want? Do I want 3 bays? Do I want 4? And that'll determine like your location. It'll determine when you plan to expand, all that different stuff. And so, I wouldn't want to sign a 10-year lease in a place with 1 bay if I plan to have 3 in the next 3 years, right? I want to be somewhere else.
Right.
So some of that big level thinking happens, you got to sit back probably every now and then and go, okay, where am I headed 10 years from now, 3 years from now? What's my 1-year plan? That kind of thing, to see, is my asset ownership really the right thing? So expansion, as well as productivity. Is the shop laid out well? Can I be efficient in there?
Yeah.
And do my customers like it? Am I in a spot where I'm going to get that customer loyalty? Maybe my fleet services are located close to there, things like that. So that big strategic picture is sometimes tough to focus on and be able to sit aside and look at, but super valuable in making that decision, buy or lease.
I also think probably, also from a strategic perspective as well, in my exit strategy, if I'm the owner and I'm looking to get out of this eventually at some point, if I have a business that owns a piece of real estate, and that is worth more to a potential purchaser than, at least to me as the seller, it's worth more than if the building isn't there now. And in that case, even if maybe the new purchaser doesn't want to buy the building, great. Now I got a way to cash flow myself by leasing it back to them. Right?
I know you've used that in the past when mom and dad want to get out of the business and kids want to come in. Mom and dad keep the asset and collect some rent over the next 15, 20 years. Great succession plan.
A great way for some cash flow to stay in the retirees' hands, perhaps, or help them fund their retirement with some additional income flow. Yeah.
Awesome.
Yeah.
Okay. Great. I hope that helps clarify a couple things there. If you need any help with the building or buy versus lease stuff, give us a call. We deal with it lots of the time. If you need help with the operating expenses, by all means, give Brian a call. We look at those things all the time and love to talk about them, actually, as odd as that is. So in summary, today we've done 2 things. We've looked at operating expenses as well as some key items in there that we want you to look at and figure out what they are. We've looked at buying versus leasing a building and other assets and some of the areas you should look at and consider in doing that. Next week, Brian, I think next week's the most fun out of this whole series.
Yeah.
We're going to talk about margins, cost of sales and revenue, and I love talking about that, and I know you do too. That's where we see a lot of power, a lot of business performance increases and improvements come out of that. And then our pro tip is going to be, we're going to fix one thing for the shop owner, and it's going to get them 3 times what their accounting fees are.
Yeah.
So I'm pretty excited to hear that. That's a great return on investment. Just from hearing this one thing, so tune in for that. I think it's going to be a lot of fun. Anything else? How can we get a hold of you? What should we look at? Things like that.
Yeah, we got the website there, moneywrench.ca. You can just give us a call, 403-405-0034.
Awesome.
Connect with us, email, Bryan, BRYAN at ejdworks.ca. Connect at moneywrench.ca. There's many ways to get in touch with us. Our website has a new chatbot feature, so there's that as well too. We're expanding our ways to get a hold of us. It's pretty easy to reach.
Comment on this post.
Exactly. Comment on the Facebook page. Somebody's going to get back to you, and we'll get you talking to the right people.
Yeah. Cool. Okay, that's great. Caitlin, we're good. Anything else you want to say? Nope. Awesome. Okay. Thanks, everyone. I'm Everett Dirksen with Brian and Caitlin, and we'll be back next week with week 3 of making more money from your P&L. We want to see you succeed, so let's get at it and have a good week.
Yeah, I'm into August 2020 already.
There we go. August. Cool.
Nice.
Okay. Thanks, everyone.
All right.
Take care.
Bye-bye.